What are rates based on?
Okay, so rates are based on, if you have a 30-year amortization, lenders will sometimes add 10 basis points to the rate compared to one that's 25-year am. A rate also depends on your down payment. Are you putting down less than 20%? You're going to get a better rate than somebody that puts down 20% or more. If you're putting down 35%, so you're at 65% loan to value, you're going to get the same rate as if somebody put down less than 20, which a lot of people don't understand. And refinance, those rates are different than a purchase. If you're buying a rental property, your rate's going to be higher than somebody who buying a property that's owner occupied. So there was a time when one of my clients called to find out, because one of these lenders had advertised online a really low rate. So she ended up calling to see what was involved with this rate. So what came with this lowest rate was you can't do anything in 5 years. You can't refinance. You can't, you had to have a bank account with them with a minimum amount of $10,000 in it. But all these little things, they don't specify when they post it on social media, right? So when they're calling us, they're like, oh, I saw so-and-so offer this. And I'm like, okay, well, do you know that within the 5 years, you can't refinance anything? And within 5 years, that's a long time. Like, studies have shown that people will break their mortgage at the 3-year term. So committing to 5 years, especially now, today, with the pandemic, a lot of people have incurred so much debt. It's very hard to commit to 5 years with one lender without breaking it at any point. And then the worst part is that if they do allow you to refinance, you have to refinance back with the same type of mortgage for another 5 years. So you don't want to get involved in that. You know what I mean? You want to make sure that when you get a mortgage, it's the right product. We need to stop focusing on the rate because the rate is not always the best choice for you.
How long should you fix your mortgage for?
So what I always do with my clients, I ask them, what are your goals for the next 5 years? Do you plan, say you have a first-time home buyer and they're like, you know what, we have stable jobs, we're happy where we are, we don't have kids right now, but we plan on having kids. And the house that they bought, is more accommodated for like 2 people, right? So you want to ask them that question. Okay, do you plan on seeing yourself in this home, for 5 years? And, a lot of the times they'll be like, oh, you know what? Like, I don't know, I might be having kids next year. And, ideally I'd like to stay for 5, but I don't know, like they're hesitant. So when you find those type of people, when you get answers like that, then maybe you want to offer them, why don't you choose a 3-year term? Or, maybe do a variable. If you're not worried about your rates, your payments fluctuating, variable is not a bad choice. It's always been proven that, variable has always been a better, rather than a fixed in saving you money, right? But if you have someone that is, they're like, no, this is my forever home. I am not moving. Like, this is it. Then those people you would want to do a longer term. They have no debts. You can see, their history, that they've always had, really good credit. Those are the type of people that would be okay to do a longer term. You pick a fixed rate, right? If you have someone that is, their debt isn't very good, they have high debt load and it's recurring over and over. You want to give different advice to people like that, right? So that's what I'm saying. It's so hard when somebody calls you and says, what's the best rate? When we don't know anything about their story. How can a mortgage broker or a mortgage agent give somebody that they don't know a rate without knowing their whole entire story, right? Because if I say to someone, you know what, well, this is the rate, it's $299. Then I pull their credit and I check and I'm like, oh my, these people don't even fit an A lender. So now we have to go to our B lending guidelines. And B lenders have higher rates. There's lender fees, there's broker fees. All because, we've actually taken a look at their whole entire application. We've checked their credit, we've seen everything, right? So now if I've told this person, yep, we can get you 299. Now they're telling me, now I go back to them and say, I'm sorry, but you actually don't qualify for this rate. It's actually going to be 4.29. So that's a big difference, right? So any broker that can tell you right away what your rate is, like, just run.
Can you explain the difference between lenders?
Okay, so an A lender would be, so there's the big banks. So those are for people that have good credit. So above 680, want to be 720 beacon score. They have no derogatory things reporting on their credit bureaus, no consumer proposals, no prior bankruptcies, no missed payments. Everything is clean on their credit bureau. They have solid jobs where the ratios will fit the A lending guidelines. So we have GDS, which is 39%, TDS, which is your total gross debt servicing, at 44%. If you fit that box, you would fit an A lender. If you don't, we have what is called B lenders. So B lenders allow higher ratios. So your gross debt servicing, so they take all your debts, your property taxes, your heat, and they take a percentage, and then they have their gross debt, their total debt servicing. You can go up to 45 and 50%, which is a big difference from 39 and 44 on your A side. But with the B lenders, they're more lenient with their lending. So a lot of the times, if you had a divorce, you got sick, and that hurt your credit, they will look at it like, okay, you know what? There's a story behind it. We have a mortgage for you, right? So they still get into what they want, but usually we do a 1-year term on a B lender because it'll take a while for someone to build up their credit, depending on how bad it is, right? But at least it gets them into the door. But the difference between A and B is that with the B lender, there's going to be a fee. Usually it's a 1% lender fee. So if your mortgage amount is $400,000, you would get charged 1% of $400,000, which is $4,000. And there's also a broker fee, which is typically 1%. And it's a one-time fee that they charge, where on the A side, there is no fees. But the thing is, it makes sense for some people. I had a client last year that, put an offer on a home. She loved this property, but the problem was we couldn't use her income. The A side wouldn't have used it. So the ratios were out of line. So she had switched jobs, and her salary, she wasn't making what she had made before. So it threw our ratio, so they didn't fit the A lending guidelines. And with the A lenders, this is what it is. You know what I mean? And she didn't want to add on a parent for a co-signer. So it was her and her common law that were purchasing together. So she's like, I really want this house. All we needed was 1 more year, and she qualifies with an A lender. So, I put her with a B lender. The rate was not terrible. She was aware of the fee, but it was worth it for her because she bought this home last year at $320,000, and today it's worth $600,000. So that's okay, because now come this year, she's going to qualify for the A lending guidelines. So we're going to take her out and put her in with the A lender for the next 5 years, right? And then there's your private lenders. So private lenders are literally your last option. So private would mean that, no A lender is going to do this mortgage. No B lender is going to touch this mortgage. But perhaps they bought firm, and they bought a house with no conditions, thinking that they are able to get financing. But for example, I had a client last week, and he bought a property, firm, no conditions, no home inspection, no condition of financing. and it closes in 25 days. So with lenders, you have to submit documents, like you have to be broker file complete, usually 5 to 10 business days prior to your closing date. So if you're doing a really quick closing like that, you have to be cognitive of your timeline, right? Because they may not be able to close on time. So anyways, he makes good money, credit is good, but the lender did not like the property. It was situated next to a train track in downtown Hamilton, and nobody liked this property. Marketability, they're like, no. So he needs to get financing, because if he doesn't close on this, you can lose your deposit that you put on the offer, and you could potentially get sued by the seller. In that kind of, respective, you got to put them in a private so they can avoid not getting sued or losing their deposit. The only problem with the private is you always have to have an exit strategy. So there's only two ways of getting out of a private. It's either you refinance to get them out, or you sell the property. There is no other option, because you don't want to just keep doing a private over a private, because it's interest only payments. And you're looking at rates, 7.99, 9.99. It all depends on, the whole deal, right? The risk to the investor that's lending the money. So there's your A lender, your B lender, and then your privates.
Which documents does a client need to get a mortgage approval?
So with every mortgage commitment, mortgage approval, the lender is going to have a list of conditions that we need to fulfill. If we don't fulfill these conditions, they can cancel the whole deal. So getting an approval doesn't mean you're actually approved. It's approved based on you being able to provide, for example, income documents. So if your salary, recent pay stub, letter of employment. It may ask for, if they're doing a purchase, they want the sale agreement, the MLS. If you're using child tax credit, they want to see the bank deposits showing the amount going in, along with the letter that you get from the CRA showing what your child tax benefit is. If you had in the application that a line of credit was going to be paid prior to you closing, we would have to provide, confirmation that balance is at zero. If we can't fulfill one of those conditions, then the lender can just cancel your deal. So we want to make sure that all your conditions are fulfilled 5 to 10 business days prior to your closing date. This way you don't run into that, delay on closing. Because again, it's happened where, people just couldn't get the documents that we needed. And, we want to avoid that. Have I ever had a deal not close? No. I like to get my documents up right away, because, people get busy. They're working, or they're with their kids, or whatever, right? So I want to be that broker, maybe annoying at the beginning, but get me this. This way, you have so much time. Like if your conditions are fulfilled, 20 days or even 30 days prior to your closing, isn't that a big relief? You want to have that weight lifted off. So all you have to wait for is signing with your lawyer, the week before closing or a few days before closing. And, especially if you're moving and, that's already a stressful, time there. We want to make it so it's easy for you. Get us these documents. Let's fulfill everything. Let's have the underwriter review it, sign it off. This way you can relax.
Are clients surprised by the amount of documents needed for a mortgage?
Sometimes I'm surprised. Sometimes I'm surprised on what underwriters will ask. Because, I find that we'll get mortgage approvals with a list of conditions that the lender is requiring. And, or like, for example, I had a client where he was hourly and his wife was hourly, and they were guaranteed the same hours every week. They wanted a letter of employment and a recent pay stub. And if you look at the pay stub, it all lines up. He's on track. He's working the guaranteed 40 hours a week. The letter confirms it. But in that original mortgage commitment, they're not asking for bank statements to show the actual payroll going into his bank account. So sometimes, certain underwriters will ask for different things. And I don't like to get too much documents from people. I like to get what I think they're going to ask for based on their type of employment, right? And then and that's where we go back to the underwriter and say, listen, he's hourly, he's on track, you've confirmed it with the employer. Why do you need these extra documents? Sometimes it works with the underwriter. They're like, you know what? No, we'll leave it the way it is. We're fine. We've satisfied. Or they'll come back and say, you know what? No, I'm sorry, but we have to have, the 3 months bank statements showing the payroll deposits. I don't like to go back to my clients because some of them will be like, oh my God, they're asking for this? Why? Why are they asking for this? And it can be annoying. I get it. But at the end of the day, our goal is to close this mortgage for you. So just get what they're asking for. Just provide it. I know, and a lot of times you can just go online. It's not like the days my mom has to go to the actual bank, go to the teller and say, I need, April, May, June. You can go onto your online banking now and literally download and save. It takes 2 seconds. So it's a lot easier for people to get things, especially this generation. Everything you can access online. It was a lot tougher, like I said, my mom's generation, my mom doesn't know how to do online. My mom doesn't know how to do an email, but they're always going to ask, underwriters are always going to ask for things that they feel is necessary. Some things are crazy, but if it gets them to do this mortgage and you close, that's all that matters, right?
What are the steps required when getting financial support from the parents?
So if we're using parents to come to help the children, whether are they gifting them the money? So sometimes the couple will qualify for a mortgage on their own, but they don't have the money for the down payment. So, but each parties are willing to give their son and daughter $50,000 each towards the down payment. So in that scenario, the ratios work. We just get a gift letter from both parties and showing the amount is deposited into their account. Really easy. If we're having parents come on as co-signers, then they own this property, so they're on title, they're on the mortgage, they actually own this property with them. So there's times where the ratios don't work, maybe because the income isn't high enough to support today's purchase prices. So we need the parents' income on the deal to help ease that load. So we're taking a whole new application, entering everything in the system. We're pulling the parents' credit. We're inputting any properties that they own, adding their income. And if the ratios work, that's great. That's a bonus for the son or the children, right? If they're going on as a guarantor, parents say, I'm just here to help them. I don't want to own this house with them. I just want to be on the mortgage. I don't want to be on title. They would go on as a guarantor. But not all lenders allow that, right? So you have to make sure, are you okay with you being on title as a co-signer, or do you just want to be on the mortgage?
What does it mean to be a guarantor?
So a guarantor is you are on the mortgage, but you're not on title for the home. So you don't own this home with your child. You're just on the mortgage to help the ratios work. So you're still checking credit, you're still checking their income, you're still inputting all of their properties that they own, any liabilities. You're just helping the ratios work so that they can be able to afford to buy the house that they want. Because their income alone doesn't work. They need that extra, I don't know, $30,000, which is going to come from the parents. But they're only on the mortgage. They don't own the house with their child. They're on the mortgage. So if they default, the parents, it's got to take care of it.
How do mortgage agents and brokers get paid?
So mortgage brokers get paid if you fit the A lending guidelines. So you have great credit, ratios are well within, your income is verifiable. We get paid by the lender. So we don't charge any fees. Anyone that's charging you a fee on the A side, it's wrong. If your mortgage fits on the B side, that's where the client's going to incur a fee. Typically, it's a 1% broker fee. We typically match what the lender charges. Some B lenders, depending on what type of mortgage product it is, like for example, if you're doing a mortgage that's a declared income, they may charge a 1.5% lender fee. So we would typically charge the 1.5%. Sometimes I've seen 0.5% lower, but generally it's the same. And then if you're doing a private's where, again, a mortgage broker will charge a fee for that because we don't get paid by the lenders. So we have to charge a fee for that service.
Do you find that clients are sometimes confused about how agents get paid?
Yeah, no, for sure. 'Cause I get it all the time, like, especially with our lead generation, they're like, okay, this sounds good, but okay, what's your fee for this? And I'm like, there is no fee. They're like, there's no fee? I'm like, no. And they're actually surprised, because I think perhaps maybe years ago, you only used a mortgage broker if you had bad credit. It's not like that anymore. People are using mortgage brokers all the time. It just saves them so much time. And you have that personal relationship with them one-on-one. I have clients calling me 9 o'clock at night. You ain't gonna get a bank person at 9 o'clock at night to answer your call. That ain't gonna happen, or they'll send me a text just because they're so stressed. And, I read it and I could say, you know what, it's 9 o'clock at night. I'm not texting them back. But I always look at it like, if that was me, and I was stressed and I wasn't able to sleep because all I had to do was send one little text to give her that reassurance and she sleeps all night, then that's what makes me happy. And you know what I mean? And I've done it so many times where I'll get this panic message at 9:30 at night and I look at it and I'm like, I can't. So I'll pick up, I've called at the 9:30 at night or I'll text and I'll say, listen, everything's fine. The lender is okay with that. And then all you hear is this, oh, thank God. Okay, I can sleep now. Thank you so much for answering that. Have a good night. Right? So that 2-second reply just made this client so happy. And she's going to remember that. Yeah.